Hello friends, today let's talk about risk management in derivatives. What are the risks involved in derivative products and markets? Fundamentally, as we know, derivative products themselves are designed to manage risk or to hedge risk. However, since these are leveraged products that are frequently used for speculation as well as arbitrage, they themselves create a lot of risk in the system and for various parties that deal in the derivative products. The products are by nature complex, they require a lot of complex risk calculations and also have specific compliance requirements. Hence, understanding and managing risk in derivatives itself is very important. Broadly, there are 5 types of risk involved in trading in derivative products. Number 1, price risk. Number 2, operational risk. Number 3, liquidity risk. Number 4, counterparty risk. And number 5, regulatory risk. Let's now understand each of these risks in detail. Fundamentally, what is price risk? Derivative products derive their price from the movement in the prices of underlying assets. The underlying assets could be of different types. They could be, for example, food grains like wheat, rice, ragi, bajra or anything like that. They could be energy products like crude oil. They could be metals like steel or maybe precious metals like gold and silver. When the prices of these underlying assets move, derivatives being leveraged products, there is a higher risk created by investing or owning into derivative products. Specifically, if you are, for example, writing an option or you are giving an option to somebody to buy or sell an asset in future. Let's say you are writing an option and giving somebody a right to buy a stock at 1000 rupees in future. Now, if the stock price goes up in the market, when that person demands that stock at 1000 rupees from you, you might have to buy from the market at, let's say, 1100 and make up for your commitment, which means you are incurring a 100 rupees loss per share. Just one example. If there's a put option that you are giving to somebody and the price in the market goes down, you will have to buy the asset at the agreed price even if the market price has gone down. In case of forward contracts also there is a risk, but forward contracts are by nature genuine hedging contracts. So there is a notional loss that can happen. For example, I agree to sell cotton to somebody 2 months down the line at, let's say, X price. Now 2 months down the line the price is higher, but still I have to fulfill my commitment, so I have to sell at price X. So there is a notional loss that I am incurring. Same can happen for the buyer also. If the price goes down in the market, still the buyer has to keep the commitment of buying from me cotton at X price, which means they are incurring notional loss. Examples of notional loss and real loss could be, for example, in GFC, in Global Financial Crisis 2008, the investment banks like the Lehman Brothers or the insurance company like AIG or American Insurance, they suffered huge losses because of movement in the price of underlying assets, which are basically mortgages. The second important risk involved in derivative products is operational risk. Derivatives operations mean you design a strategy, you have trading software through which you implement the strategy, you create some kind of documentation, you execute the transaction, you monitor the positions, you do risk calculations, you put margins with the exchanges, you clear and settle the trades. So all these require you to do a lot of calculations, do documentations, do proper execution on time. So there could be a lot of mistakes that might happen. For example, human errors. Instead of, for example, buying an option, you might sell an option, or maybe you put in a wrong quantity, right? So all kind of these options or possibilities exist. Your IT systems might fail, so you may not be able to square up the position. And if you are not able to square up the positions, you might be required to make the delivery, right, at the time of settlements. There could be improper documentation with the customer and the customer may not own the transaction that is executed on their behalf. So human errors, inadequate training, frauds are basically what leads to the operational risk, and there are more possibility in the derivative products. The third important risk in derivative products is liquidity risk. Liquidity is the ability to convert asset into cash or square off your positions. For example, if you are not able to square off your positions before the last trading day and time, then you might have to fulfill your obligations under the futures or options contract. The cash settlement may not be allowed to you. The exchange might assign an obligation to you. So in that case, you'll have to probably buy the product from the market, keep up your commitment of delivery at the specific locations. So this requires you to invest more time, more effort. the cost of execution might go up and you may not realize a good price. So liquidity risk also exists in the derivative products. The fourth important risk in the derivative products is the counterparty risk or the default risk. If you are entering specifically into OTC contract with the counterparty and that counterparty, let's say, goes bankrupt, they go into liquidation. In that case, there is no counterparty available for fulfilling their side of the contract, which means now you have to find some other party to fulfill the transaction, and these being very custom transactions, it is not easy to find the counterparty again. The default could be intentional, there could be some amount of misunderstanding, there could be reconciliation issues, you say that we have committed to deliver so much, the counterparty has some different understanding, you have not followed, for example, the ISDA documentation properly, right? GFC 2008 is another good example of a counterparty risk. Companies like American Insurance Company, for American Insurance Group, for example, AIG went bankrupt because Lehman Brothers went bankrupt, and some of the companies like Countrywide Financials, which was a GE subsidiary, they went bankrupt because of the underlying mortgage issues. The fifth important risk in derivative products is regulatory risk, which is around enforceability of the contract. So there might be jurisdiction issues. You have entered into a contract with the counterparties in, let's say, UK, and the jurisdiction is UK, which means that there is a huge cost of settling that dispute in UK, for example, for an Indian company. The legal wording in the contract could be wrong if you have not followed the standards or you don't have proper legal advice. The cost of enforcement of the contract, in case you have to take the party to the courts, that could incur very high cost for you. There could be delays in settlement, for example, in fulfilling obligations, or the laws of the respective countries might change. So regulatory risk is much higher if you are doing any kind of derivative contracts across the geographies. Now, first and foremost, we have to understand that there are higher risks involved in the OTC derivative products as compared to exchange traded derivative products, because in case of ETD or exchange traded derivative products, most of the regulations are clearly specified by the exchanges. So the requirement of documentation, of operational compliance, legal compliance are relatively less. But if it's a OTC contract between two parties, you have to make sure that your documentation is in order, you have followed everything right to the T, you have got proper legal advice, and you are able to enforce the contract. So OTC contracts by nature carry a higher risk. Understanding these risks in derivative products will help you manage your risk better, of course, and leverage derivatives for risk-return trade-off in your own portfolio as well. You will be able to manage the compliances better, and also you will be able to identify and fulfill risk and compliance roles in the derivatives markets, which are very good roles to start with. I hope you have found this video useful. If yes, please do like this video. Also subscribe to my channel and share this video to your friends who might benefit from this. Thank you very much. Take care. Cheers.